Good morning, dear learners. Welcome to Genius Galaxy Coaching. Our today's discussion, fundamental of accounting, especially accounting equation. In continuation to our previous discussion, we will learn the effect of transaction on accounting equation precisely. Let's move. So our discussion mainly focus on Cambridge O-Level Accounting 77007 course, and especially for the student who are going to take exam for 2027, 2028, and 2029. Our previous discussion was fundamental of accounting, the purpose of accounting, account equation. Just what is accounting? I am just going to recap from our previous discussion. Accounting is the process of recording, classifying, summarizing, and interpreting the financial transactions of a business in monetary terms to show its financial performance and position. The purpose of accounting: to keep systematic records of business transactions, to determine profit or loss of the business, to show the financial position of the business through financial statements, to provide financial information for decision making by owners, managers, and other stakeholders or users. So accounting equation, the accounting equation represents the relationship between a company's asset, liabilities, and equity or capital. Here is the equation: assets equal to capital plus liabilities, or assets equal to owner's equity plus liabilities. Now I am going to discuss the effect of transaction on accounting equation from these books. This is the example from this book. Here is given. Just I will discuss every transaction, how it is impacting on the equation. So January 1, Lina set up a business to trade under the name of the dress shop. She opened a business bank account and paid in 20,000 as capital. So in January 1, Lina set up a business and initially he invested 20,000 as capital. And this 20,000 deposited directly into the business bank account. So what will happen? Here we know the business is different from the owner. So what is happening? Now the business account has balance 20,000 in the bank account. So its asset bank balance is increased by 20,000. Similarly, right hand side, this is the capital 20,000 new capital, it is increasing by 20,000. So the equation is balanced. Bank deposit 20,000 asset, capital 20,000. This is the owner's equity or capital. Again, number 2, the business purchased premises 15,000 and paid by check. What is happening here? One asset, premises, now will be increased by 15,000, and another asset, bank account, bank balance will be reduced by 15,000. That's why here we will see for January 2, premises now 15,000, one asset increases, and bank balance now 5,000 instead of 20,000. Since 20,000 is segregated in two assets, now bank balance 5,000 remaining and premises 15,000. This is the balance 20,000. Right hand side is still untouched here, capital 20,000. This January to transaction only affect asset sides. One asset decreases and another asset increases. January 3, what is happening here? The business purchased goods 3,000 on credit. So here goods purchase means this amount, these goods will be resold further. So it is not like premises, it is treated as inventory. So inventory, new asset, inventory is increased by 3000, and right hand side this amount is purchase on credit. So accounts payable or trade payable will generate right hand side 3000. We will see here 3000. So the effect of January 3 is uh, 3000 inventory increases and trade payable liabilities created 3000 since it is purchased on credit. Number 4, the business sold goods at the cost price 1000 on credit. Here is the beauty. The business sells this, but it is a cost price. No benefit, no actual benefit here. But sales at the cost price. That means here inventory will reduce by 1000, and since it is sales on credit, trade receivable will be created by 1000. Look here. Number 4, premises 15,000 previous. Now inventory will go down 2,000 since out of 3,000, 1,000 sells. So 3,000 here, trade receivable 1,000, bank balance 5,000. So left hand side 23,000 total asset, and right hand side it is still 23,000. 20,000 capital and trade payable 3,000. They both are balanced. Now I am going to another problem. This is taken from this book, Weigand Camel, Accounting Principles, 12th edition. Here is the problem. Transaction made by Varmari and Co., a public accounting firm, for the month of August are shown below. Preparing a tabular analysis which shows the effects of these transactions on the expanded accounting equation, similar to that shows in illustration 1 to 8. Here are 5 transactions given, just we will see the impact of the equation. So our equation is main equation, assets equal to liabilities plus owner's equity. So first one, the owners invested 25,000 cash in the business. So what is happening here, instead of bank, which is in our previous discussion, now owner is investing in cash. So what will happen, another asset, cash is increased by 25,000 and owner's equity or capital will be increased by 25,000. So this is the first one effect, 25,000 increased cash and owner's equity increased 25,000. That is plus. Number 2, the company purchased 7,000 of equipment on credit. So what will happen now? Equipment purchase 7,000. So equipment asset will increase by 7,000, and it is since it is on credit, so liability, accounts payable or trade payable will increase by, this is account payable will increase by 7,000. So what we will see here for, yes, for 2 equipment 7,000 increases and accounts payable 7,000 increases since purchase on credit. Number 3, the company received 8,000 cash in exchange of service performed. The company provided service and received cash. So what is happening here? Cash is increased by 8,000. Here we look here 3 plus 8,000. And another side, revenue. It is a revenue. So revenue plus. Through our expanded equation, you can remember from our previous discussion, this is owner's capital less drawings, owner's drawings. If owner's withdraws money, then it will be deducted, and if revenue generated, it will be plus, and expenses will reduce the owner's equity. So minus expenses. Here for 3, 8,000 it is a revenue. So 8,000 cash increases and revenue increases plus. Number 4, the company paid 850 for the month's rent. So this is expenses. So what will happen? 850 cash will go down. Here look for cash 850 minus, and owner's equity also go down since it is expenses. Expenses 850 minus. Here expenses 150 minus. So this will know same effect both side. Number 5, the owners withdraw 1000 cash for personal use. So the owners, when owners withdraw, cash withdraw. So cash will reduce by 1000. See here 5 minus 1000. And similarly, drawings minus 1000. Owner's equity will go down. So now if we add them in cash, now after adding plus and minus, now cash balance is 31,000. Total here 31,150 cash and equipment 7,000. So total asset is 38,150. This is the left hand side. Equipment 7,000 in our hand, and now cash after adding and deducting the result is 31,150. So total asset 30,150 plus 7,000 equal to 38,150. This is total cash. So liabilities, what is happening here? 7,000 liabilities. Owner's capital 25,000. Owner's drawing minus 1,000. Revenue plus 8,000. Expenses minus 850. If we add them plus minus, then the total figure will be 38,150 in right hand side. So that's all to today's discussion. Actually, this is the impact of the accounting equation. I think we are close this discussion for this chapter. We will go forward to the next chapter later on. Thank you for watching my lecture. If you like, you can subscribe my channel and press comment. If you need any assistance, you can text me or through comment or email or WhatsApp. I will try my best to deliver your response, your answer, your problem. I will try to solve your problem. Thanks, guys. Hope to see you later on. Bye for now. Thanks.